we are going to start my section with the F bars. And so it's chapter 13, page 3, and we'll do F bar and FATCA issues. I think a lot of you know that this has become an extremely serious area within taxes. The rules for F bar, quite frankly, they've been around for a while. I remember when I first graduated law school, my first job was I'll date myself a little bit, was in a Big 8 accounting firm. That's where I cut my teeth on taxes. I was in their tax department. During the busy season, we did a lot of individual returns, and that's what they assigned me. So one day, a partner was coming down the aisle where I was working, and there was a manager who was asking me a question. Hey, Art, how far are you on the Jones return? And so I said, well, I'm up to the no-no questions. So the tax partner turns to me and says, what the heck is a no-no question? I said, on Schedule B, there's 2 questions. Do you have foreign bank accounts? Do you have transactions with a foreign trust? They're the no-no questions. He goes, well, why do you call them the no-no questions? I said, because I've been here now for 3 months, and we haven't had, I'm doing 3 months of busy season, we haven't had a single return where I've ever answered that question yes. So they've been around for a while. 9/11, I think, changed things after the panic ended, and Congress was now trying to figure out how these atrocities could have occurred. They determined that there was money offshore that was funding the terrorists. And so they were thinking about how to start figuring out where offshore wealth was. And there was a congressman who said, we already have the law. It's just not being enforced. And so, yes, we can get taxpayers to disclose where assets are. Obviously, there's another reason. The other reason is that there must have been a number of taxpayers who had offshore wealth and they weren't paying taxes on it. So it's serious, and what makes it real serious? 2 things. The civil penalties are significant, at least $10,000. There's also potential criminal penalty. I read an article in Forbes magazine, I'm going to say it was about a year and a half ago or so. There's a number of good tax authors in Forbes. This one was telling about an individual, she was a Floridian, who had a number of accounts, be it brokerage accounts or bank accounts in banks and brokerage houses in Belgium. She had not, and this is the backup of the story, she had not reported the wealth forever. It's like over 20 years. Didn't report the income, didn't disclose the assets. She gets a notification from one of the brokerages in Belgium saying that the Justice Department was making inquiries about her. I guess she panicked. She withdrew all the accounts in Belgium and switched them to banks and brokerage houses in Luxembourg, not realizing that federal government has unlimited resources. They kept investigating. They eventually indict her. They eventually try her. She's found guilty of tax evasion and failure to disclose foreign assets. So that's the backup of the story. What was the article about? The article was about the penalty phase of the trial. Now, this woman was 73 years old. So her attorney goes to the judge and says, Your Honor, I do not believe it is in the best interest of justice to jail a 73-year-old woman. And the judge replied, with all due respect, counselor, I do believe it is in the best interest of justice to jail a 73-year-old woman who knowingly evaded taxes, who knowingly failed to disclose assets, and who knowingly obstructed an investigation by the Justice Department. She was sentenced to 3.5 years in jail. What's the point? Age is not an issue. They are very serious. There are no places that you really can hide wealth that is safe anymore. And what we need to do with clients is we need to make sure that they understand this. We need to educate the client. We need to educate them that they can't not tell us that everything. So we are involved. There are cases in the book, in this chapter, where I think it's 2 or 3, where EAs and CPAs were sued by their clients because the FinCEN 114, it was actually called TDF 9022.1 when these cases happened, it was not filed. And civil penalties were issued. So they sued their professionals saying, you didn't do this return for me. The response in each case, they're independent cases, it was just a simple response. The response was, we are not engaged to do that.